Okay. I hope we can see the screen. Hello?
Yes.
Okay. Wonderful. Okay, so today we are looking at IES 40, investment property. Okay, it's a very short standard. So we'll finish very soon. Okay. Okay, so there are two words here. We have investments and then we have property. Property, as we know, is under IAS 16. So we are already familiar with property. But probably the new term is what? The investment. But investment is not a string term. We are all familiar with what investment is. Investment is basically committing certain resources now with the hope of earning future returns. So you commit an amount of resources in, let's say, in an investment instrument with the hope of earning some returns in the form of maybe dividends or rents or interest in the future. Okay, so when we say investment property, there are different types of investments. So we have um, investing in bonds. You can invest in bonds, treasury bills. Okay, what else? Unit trust and so on. Okay, these are let's say financial investments. All right. Okay, but here we are talking about investing in property, like physical property. Do you get it? In the form of buildings, in the form of maybe buildings, maybe projects, maybe stores, facilities. Okay, so that's what we are talking about. Investing in tangible assets like this, buildings, projects, lands. Okay, yeah. So I mean, we invest or people invest in such properties with the hope of earning some rewards. So, for instance, landlords put up buildings, hostels, buildings to rent so that they can earn some what rentals. Okay, so that they can earn some rental. So that building becomes an investment property. All right. So investment property is basically any property uh, that we build or we construct with the hope of earning some periodic returns. All right. So that's basically what investment property is. So our job today is to determine the accounting treatment. When it comes to the standards, uh, one of the key issues that will be ringing all the time is the accounting treatment. Okay, how to treat certain transactions. Okay, so like I mentioned earlier, investment property is an asset. So of course, it will be under in our balance sheet. We will record it under assets. Okay, in our balance sheet, we will record it under what assets. So we record it as assets. So if it's 5 million, whatever it is, then you put the value here. All right. Yeah. So that's basically what investment property is. But now we are going to look at initial measurements. Okay. And then we'll look at subsequent measurements. So the initial measurement and what subsequent measurements. So when we say initial measurements, we are talking about um, how the first the what's the name, the recognizing the property first time in the account or in the financial statements. How do we go about it first time in our account? Okay, the subsequent measurement is about, I mean, the the preceding years or the subsequent years. How do we recognize that property in our books? Okay, so that's the introduction to investments property. All right, so let's continue. So, what is investment property? Investment property, according to the standard, okay, refers to what refers to it's a property which could be a land. Okay, so when we are talking about property, we are talking about land, building. Okay, basically land and building, or part of a building, or both. So it can be land and build. It can be only land. It can be only building. It can be land and building. Okay, or it can be part of buildings. Maybe you can have a building like this, and half of it is for what, investments. So let's say a landlord has built 2 rooms and has given one out as rent, for rent. Okay, so it means part of the building is investment property, and this one is called what, owner occupied. The one that the owner is using is called owner occupied. The one that is given out is called investment property. Do you get it? So that's how it is. Okay, that's how it is. So it's a property which is land or a building or part of a land or part of a building or both, held by the owner. Okay, so it is owned by. So when you take this building, it is this investment property is owned by the owner of the property or by the lessee. The owner is sometimes called lessee. Okay, under a finance lease to earn rentals or for capital appreciation or both. So this side is talking about the benefits of the investment property. Okay, this side is talking about the benefits. So the benefit is whether either we get rentals. So rental is the periodic amount that the tenant will pay to the landlord. That's the rentals, or capital appreciation. So here we are referring to the value of the assets increasing. So for instance, if you have land, a parcel of land like this, land usually um, appreciates in value. So you can buy a land today for maybe $1 million, and you can hold it as investment property and wait for the value to increase to maybe 3 million, and then you sell it. Okay, so we hold investment property for rentals or capital appreciation. We want the value to increase. Okay, or two, or we want to earn rentals plus capital appreciation. Okay, so either this or that or both. Do you get it? So that's the reason why we hold investment property. Okay, so let's look at oh sorry, let's look at examples of investment property. We have examples of investment property. Oh, Michael is not on the line. I see. Okay, so let's look at examples of investment property. We have Land held for long-term capital appreciation. Okay, land. If you have land and you just buy it and hold it for the capital, for the value to appreciate. Okay, so that is capital appreciation. Or land held for undetermined future use. If you buy a land and you don't know what you are going to do with it, the land is still there. So it is assumed that it is an investment property. Okay, so a land that is there without any plan, it becomes an investment property. Yeah, so let's continue. Then we have building leased out under an operating lease. This is talking about rent. Buildings that are held for rent. Okay, that's lease. Okay. Then vacant building held to be leased out under an operating lease. Okay, vacant building held to be leased out. So here you have a building. Yeah, the building is there, but no one is occupying it. But we are waiting for someone to come and rent. So it is what, an investment property, or property that is being constructed or developed for future use as an investment property. So if we have a property and we are building, let's say a company is building a hostel, a big hostel for university students. Okay, so a very big hostel. Okay, story building. So the building is not complete. Okay, so even though it's not complete, because we are building to rent it out, it becomes an investment property. Okay, so these are examples of investment property. All right. So um let's look at examples of properties that are not investment property. Okay, examples of properties that are not investment properties. One, property held for use. Property held for use in the production or supply of goods or services or for administrative purposes. So this is talking about PPE. Any property that we are using, okay, is not an investment property. Okay. Two, property held for sale in the ordinary course of business. Any property that we sell, or which is like an inventory to us, is not an investment property. Example is real estate companies. Real estate companies, what they do is they build apartments, rooms, and houses, and they sell. So if real estate have buildings, okay, that they are selling, you will think that it's an investment property. It is not an investment property because that is their work. That is the business they are into. Their business is to build and sell. Okay, so the buildings becomes like an inventory for them. Okay, the buildings that they are setting up, constructing, is an inventory. It's not investment property. Then property being constructed or developed on behalf of third parties. Okay. So if you are building a property for someone, okay, let's say you're a real estate company, somebody has contracted you to build a apartment for the person. That property is not an investment property. Okay, so that is it. Property leased to another entity under a finance lease. Okay, under a finance lease. If um a property is given out to a person, when we say finance lease, yeah, it's a whole standard on its own. Okay, so let's say that you have a car, you have a car, and then somebody is interested in it. Okay, somebody is interested in it, but the person cannot pay outright. So the person is paying in installments. Okay, every year or periodically, the person is paying. All right. So um, the fact that the person is paying you periodic amounts doesn't mean this car is an investment property. Do you get it? This car is more of a finance lease. So what it means is that at the end of the term, maybe if you agree that the person should pay for 5 years, after 5 years, you have to hand over the car to the what's the name? The person who made the payment. Okay, so in that case, it is not an investment property. Okay, because at the end of the period, the ownership will tend to, or the ownership will be transferred to the we call it lessee. Okay, so where any arrangement where the ownership will be transferred to another person at the end of the day, is not an an investment property. Okay, so that's what this point is talking about. Okay, that's what this point is talking about. Okay, let's continue. Let's look at how to recognize investment property. So to recognize investment property, two conditions must be met. Okay, these two conditions are, very important. This and what's this? One is that you expect future economic benefits. Okay, which means the investment property you expect to earn some benefit from it, like in the form of rentals. Okay, and then two, you can measure the cost. Okay, you should be able to measure the cost. What is the cost of that property? So if these two conditions are met, if you are able to provide, if you are able to, what's the name? If you're able to indicate that, if you're able to provide the cost and also prove that the investment property can provide economic benefits, then we can go ahead and recognize it in our financial statements. Okay, now let's come to the recognition. So with the recognition, there are two ways of recognizing investment property. We can use the cost model or the fair value model. We can use this and that. Okay, according to the standard. But the standard recommends the fair value model, not the cost model. Yeah, so most of the investment property questions you come across the fair value model. The cost model, is when you cannot determine the fair value. That's where you go by the cost model. But if you can determine the fair value, you shouldn't use the cost model. Okay, the cost model is the cost minus the accumulated depreciation, just like what we did for PPE. Okay, but investment property, you don't. It's not advisable for you to depreciate it. Okay, it's not because you are not even using it. It is you are renting it out, and usually you are even interested in the value of it to appreciate. Okay, so the cost model is not advisable. But then, if you don't have the fair value model, if you don't have the fair value, then you can go use this. The fair value is the market value. Mhm. Yeah, it's the market value. So, assuming that you have a hostel, you set up a big hostel for students, okay, and you are giving it out, renting it, okay. You are interested in the value of the hostel at any point in time. You are interested in the market value. You are not really interested in the cost minus the depreciation. Okay, so that is the recommended measurements for investment property, the fair value model. Now let's come to transfers. Okay, transfers. Okay, so when we say transfers, what are we talking about? Okay, transfers. Okay, you can have maybe you have two rooms. Maybe okay, let's say you have three-bedroom apartments. Okay, you have three-bedroom apartments like this. Uh, so this is one room. This is another room. So one, two, three. So right now you are staying in it. Okay, and this is located in maybe maybe Accra. Okay, because you are working in Accra, so you are staying in it. Assuming that you are a government worker, you have been transferred to maybe maybe Kumasi, so now you are here. Yeah, and nobody is staying in this room. So now you are in Kumasi, and now nobody is here. So you've decided to rent this. Yeah, it is. I mean, it makes sense to rent it instead of leaving it like that. Okay, so what this means is that this property has changed, or you have changed the nature of the property. Okay, so initially it was owner occupied. Is that not so, isn't it? Because you were staying in it, but now you have given it out. So now it has become investment property. Yeah. Okay, so here we are talking about, so there's one type of transfers, okay, where we have owner occupied towards investment property. So we have owner occupied towards investment property. Yeah, like that. Now you can also have an investment property. Maybe you have a house you are renting, and um, you have a house, a very nice house you are renting, and um, you are renting out. It's for you. You are renting out. Okay, and now you decided that you are no longer going to rent. Maybe you are a landlord, and the tenant staying in this room is troublesome. So because of what the tenants has done to you, all the tenants that come here, they don't treat the facility or the building well. So you are decided that, okay, you will not rent it again. Okay, so um now this building will be, so now you will not rent it, but you are coming to stay in it. Okay, you are coming to stay in it. So it means that this building has moved from investment property towards owner occupied. Do you get it? So there are two types of transfers. Okay, we have owner occupied to investment property to owner occupied. So we have owner occupied to investment property. Then we also have investment property to owner occupied. Okay, so the next thing we have to look at is what is the treatment? How do we treat what's the accounting treatment for this? And what is the accounting treatment for this? Okay, so that's what we are going to. Okay, so now let's start from owner. Let's start with this one. Owner occupied to investment property. Okay, so when the property was under owner occupied, okay, we usually owner occupied property is usually PPE. Okay, it's usually property. It's under IAS 16. Okay, now it is moving to IAS 40. Okay, this is IAS 16. This is IAS 40. So under IAS 16, the property is carried at cost minus accumulated depreciation. Usually, that's how we carry investment property. Sorry, owner occupied is what the cost minus accumulated depreciation, which will give you the carrying amount. Is that not so? The cost minus the accumulated depreciation will give you the carrying amount. But when we move here, when we move to IS 40, like I explained earlier, usually investment property is carried at fair value. So when we move the property here, we are not going to use the carrying amount. We have to use the fair value. Do you get it? So under when the property was under owner occupied, we are using the cost model and all that, and we are determining the current amounts here. But when we move here, it becomes we use the fair value. Okay, so for instance, let's say when the building was here, owner occupied, the current amount was 50,000. Okay, but when we moved it to the investment property, the fair value is 70,000. You know, remember that the fair value is the market's value, so it can be different from the carrying amount. Do you get it? It can be different from the carrying amount. So now you can see that the building was 50,000, and now it has increased to 70,000. So there's an increase of how much? How much is the increase?
20,000.
20,000. Good. Okay, so this 20,000, we have to treat it as what? Like capital surplus. Do you get it? Capital what? Surplus. Do you get it? So the summary is that when you are moving a property under owner occupied to the investment property, you have to compare the carrying amount when it was under owner occupied to the fair value, and then note the changes. If the fair value is more than the carrying amount, we will get capital surplus. Okay, if the carrying amount is more than the fair value, we'll get impairment. Do you get it? So you have to note. So always you have to check the differences. Okay, so that is unoccupied to investment property. So so the standard says that IAS 16 should be applied up to the date of the reclassification. Okay, so it's saying that when the building is under owner occupied, we should use IAS 16. Okay, so which is the what we did, the cost minus the accumulated depreciation. Okay, but when we move to investment property, we have to use the fair value. Okay, so there can be differences. So what does the standard say? The standard says that any difference arising between the carrying amounts and the IAS 16 at the dates and the fair value is dealt with as revaluation. So if there's any difference, like that means there will be differences. So if there's any difference, we have to treat it as capital surplus. So we have dealt with this. Now let's come to this. We can have investment property and we moved it to owner occupied. Okay. So when the building is under investment property, okay, and now we are moving to owner occupied. So when the building was under investment property, usually we use the fair value. Okay, but when it comes here, we use the cost. Okay, so it's saying that when the building is moved from, or when the property is moved from investment property to owner occupied, the new carrying amount under the owner occupied should be the same as the fair value. Okay, so for instance, when the building was under investment property, the fair value was 55,000. When we move it here, okay, we should use the fair value as the cost. So it means we have to maintain the figures. Okay, we have to maintain the figure. The fair value is the same as the cost under this transfer. Okay, but from owner occupied to investment property, that is where we can have differences. Okay, so because under under this one, which one? Yeah, the owner occupied to investment property. Under the cost, under owner occupied, we already have the carrying amount. Okay, we already have the carrying amount, and then when it comes to fair value, we can also determine it. We can also determine it. Okay, but when it comes to this side, the investment property to owner occupied, okay, probably even though we may know the cost, I mean, but that will not be we may know the original cost of the property, okay, but we may not know the carrying amount because we are not even depreciating it because it's not under owner occupied for us to be depreciating it. Okay, so it will be difficult for us to determine the carrying amount. Okay, so that is why we maintain the same amount. Okay, so the fair value will be our new cost under the owner occupied. Okay, is there any question? Hello, are you good?
Yes, Mark, you are good.
uh Great, great. Wow, wonderful. So let's continue. Okay, so we let's solve a question here. Question one. A business owns a building which it has been using as a head office. Okay. In order to reduce costs, on 30th June 2009, it moved its head office functions to one of its production centers and is now letting out its head office. Company policy is to use the fair value model for investment property. The building had an original cost of on 1st January 2000 of $250,000 and was being depreciated over 50 years. At 30th June 2009, its fair value was judged to be $350,000 required. How would this appear in the financial statements at 31st December 2009? Okay, so let me summarize this question. So there's a business, and they owns a building, and they were using the building as head office. And in order to reduce costs, they decided to relocate. They moved their head office functions from where the building is, and they relocated. And now they are letting out the head office. So now they are renting the head office, the head office building. Okay, so that's all. That's the question is talking about. So and they are giving us extra information that the building original cost was 250,000 and the depreciation was 50 years. And now, as at the dates of the transfer, which is 30th June, the fair value of the building is 350,000. Okay, so they are telling us to account for this in the financial statements. So the first question you have to ask yourself is, yeah, we need to know what type of transfer it is. So based on this question, what do you think? What type of transfer is this? Is it owner occupied to investment property or investment property to owner occupied?
Um,
What do you think?
occupied to. Okay, please. The business wants to go. Yeah, from owner property to investment property.
Okay, yeah, that's good. Yeah, so they were using it, and now um they decided to rent it. So it means that it is to owner occupied to what investment property. uh So we learned that when it was under owner occupied, we were carrying it using the cost minus accumulated depreciation. But under here, we are using the fair value. Okay, so now we need to know the carrying amount. Okay, so that we'll compare it to the fair value. So that we will see if there are any increase or decrease. Okay, so let's determine the carrying amount of this asset. So the carrying amount, is the cost minus accumulated depreciation. Okay, so when was the building acquired? The building was acquired on 1st January 2000, and the cost is 2000, and the cost is 250,000. Okay, good. Now we have to calculate the depreciation or the accumulated depreciation. Alright, so for us to calculate the accumulated depreciation, we need to know how long we used the building before we decided to sell it. Oh, sorry, before we decided to rent it. Okay, so we started using the building from 1st January 2000 to 30th June. So how many years? Okay, how many years is it? So we need to know. So we have 2000 um 2001, 2002, 2003, 2004, 2005, 2006, 2007, 2008, 2009. So how many years? 1, 2, 3, 4, 5, 6, 7, 8, 9. So it's 9 years. Okay. But we decided to sell it on 30th June. Okay, so that will be 6 months. 1st January to 30th June is 6 months. So this is 6 months. So it means that the total period is 9 years plus 6 months, which will be 9.5 years. So this is half. Okay, so it means we used it for 9.5 years before we decided to sell it. So it means our accumulated depreciation will
Hello,
multiply it
Max.
high.
Yes, Max.
Mhm.
The date of acquisition is January 2000.
Yes, yeah.
Right. So I'm just thinking that shouldn't we start from 2000 rather than 2021? 2001.
Oh, okay.
Mhm.
Yeah, okay, I get your point. Okay, so we can also do it this way. Let me. Okay, so they acquired it here. Okay, so from 1st January to 31st December 2000. Okay, this will be 1 year, right? Yeah, from 1st January to 31st December, it will be 1 year. Okay, so this is 1 year. 31st December 2001 will be 2 years. 2002 will be 3 years. 2003 will be 4 years. 2005 will be 5 years. 2006. Hey, 1, 2, 3.
Eight and a half.
Did I miss something? This is 1, 2, 3, 4. Okay, 2004. Okay, this is 4. 2004 will be 5 years. 2005 will be 6 years. 2007 will be 7 years. 2008 will be 2000. Wait, there's 2006 and 2007. 2007 will be 8 years. 2009. 2008 will be 9 years. 2009 will be 10 years. Yeah, okay. So this one, it will be 10 years if it is at the end of 2009. Okay, but here we are looking at the beginning of 2009. Okay, you can see that all of these are end of the years. This is end of end of the various years. So this 10 years is end of 2009. That will give you 10 years. But we are interested in beginning of 2009. So which will be 9 years. Do you get it? Which will be 9 years. And then we entered into 2009, but we transferred it in the middle of the year, which is 5 months, sorry, 6 months into the year. Okay, so which will give us the 9 years plus the 6 months. I hope you get it. Yeah. So it means
Now,
this is
the,
hello.
the first the first from January to January from 1st January to January 2000 to the 3rd December 2000, right? The first year.
Yes, the first year is from 1st January to 31st December 2000. It will be 1 year. Do you get it?
Yeah.
So that's the first year. From 1st January to 31st December 2001 will give you 1 year. Mhm. So that is. So at the end of the day, you get 9 years, 5 months. Okay. So now sometimes this thing can be confusing, but what can we do? I mean, with time we'll get used to it. Okay, so it means our depreciation is going to be um okay, our depreciation, we will depreciate it for 9.5 years. So we need to know depreciation charge per year. Okay, so depreciation per year will be the cost 250,000 over the useful life, which is 50. So how much are we going to get? So 250,000 divided by 50 will give us 5,000. So this is 5,000. So it means our accumulated depreciation is going to be 5,000 multiplied by 9.5 years. You agree with me, right? So how much are we going to get? So we'll get
47.5.
yeah 47,500. So at the end of the day, our carrying amount is going to be 250,000 minus 47,000. So we get 202,500. So this will be our carrying amount on the date of on the transfer. Okay. So we have to compare it to the carrying amount. Sorry, to the fair value. So the carrying amount is 202,500. So 202,500. Then our fair value is going to be, so our fair value is given to us in the question, which is this. At 30th June 2009, its fair value was judged to be 350,000. So we can see that the fair value is more than the carrying amount. So we will have a revaluation surplus. Okay. So how much will be our revaluation surplus? So 250. So we are going to get 147,500. So this is going to be our revaluation surplus. Okay. So now let's see how we will show it in our balance sheet. So in our balance sheet, under our assets, okay, under non-current assets, okay, and then we'll have investment property, okay. So the new value will be this. Okay. Okay. Then we'll come to equity. Then we have what? Capital surplus. Then we'll put this one here. Okay, so this is how our balance sheet is going to look like. So this is how it's going to look like. It's very straightforward. All right. Any question? Okay. So that is it. Let me see. Okay, so I think we are done with it. Okay, another issue under investment property is, I mentioned earlier that investment property we use the fair value. Okay, so the fair value can change. Okay, so when there can be a change, so maybe at the beginning of the year, you may have a fair value of maybe 5,000 for the investment property. Okay, but at the end of the year, 31st December, the fair value can maybe increase, maybe to 6,000. Okay, so now the increase, we call it fair value gain. Okay, we call it fair value gain, and in this case is 1,000. Okay, so the question is, where do we record the fair value gain? Okay, the fair value gain is recorded in the income statement. So we'll record it in the income statement as fair value gain. We can also have a loss. It can also reduce to maybe 3,000. So that would be fair value loss. It will also be recognized in the income statement. Okay, so that's one thing you should also note under investment property. Okay, any question? So if there's no question, then that's it for investment property. So you can see that it's not difficult. Okay, let's move on to the next standard. All right, so I think let's go for a 2 minutes break. Then we'll start with the next standard. I'll let to cool off small. Let's go for cooling off and come back. Okay, just some 3 minutes break and then. Hello? Yeah, Mr. Martin.
Max, Adeo.
Okay, you did. Okay, good. All right. Okay, let's continue. Okay, so we are looking at IFRS 16 leases. Okay, leases and lease IFRS 16 is an important standard. Okay, and usually it is popular in the examination. You usually encounter it in the examination, so you have to master it. But it is not a difficult. It's not a difficult standard. Okay, it's not. It's very straightforward and easy. Okay, so first of all, we need to understand what a lease is. Okay, I'm sure we are familiar with the word lease. Okay, lease is basically giving somebody right to use your assets. Giving somebody right to use your assets, and then the person will pay you for that right. So, for instance, if you have a room, you are renting, okay, and then you have so this is the owner. We have the owner here. Then we have the tenants. Okay. So this person under lease, he's called lessor, and this person is called lessee. Okay, you have a room. This person wants a room. This person cannot. Maybe this person is. Let's say this person is in Kumasi, but got a job in Accra, but he needs a place to stay. He cannot within a short time build a house. He has to rent a house, a place to stay. So he has to find a landlord, someone who owns, who has a building for rent. Okay, and then they will enter into an agreement. These two guys will enter into agreement, and this person will pay the owner. So once this person pays the owner, then this person will give the tenant the right to come and use the assets. Okay. So a lease is an agreement where the owner of a property, okay, gives the right gives a right to someone else to come and use the property in exchange for a consideration. So the person who is coming to use the asset has to pay for it, has to pay for that right to use the asset. So we are coming to learn about the accounting treatment of this transaction or this type of contracts. Okay, so that's basically what we are coming to do. So let's look at the definition of a lease. A lease is a contract, okay, that conveys the right to use an asset for a period of time in exchange for a consideration. Okay, so you are given right to pay, right to use the assets for a period of time. So that's the lease term. It can be 2 years, 1 year, 6 months, and then you have to pay for it. Okay, in exchange for consideration. All right. A lease is a way of obtaining a use of an asset, such as a machine, without purchasing it outright. Okay, so a lease is a way of using an asset without buying it. Okay, so for instance, this guy is from Kumasi, has come to Accra. He cannot buy a house these days. I mean, houses are expensive. You can't buy a house, so the only thing you can do is to go for rent. Okay, and he will, once he's able to rent, he will get to enjoy the benefits associated with this building. Okay, so a lease allows you to use a machine or a property without buying it. Okay, buying it outright. Okay, so let's look at some definitions under lease. Okay, so like I said, lease is a contract. Okay, it's a contract. So let's look at our example. So this guy is from Kumasi. Came to Accra, came to the city, the capital. He has got a job at maybe EcoBank. So he got a good job here as maybe the manager. So he has come to Accra here. He needs a place to lay his head. So he will usually use agents. Agents will help him to find a landlord or help him to get a place. So once they find the place and he likes the place, okay, then he'll try and meet the landlord. The landlord and this man will meet. They will have a meeting, and then in the meeting, the landlord will say, "Okay, this is my house. I'm the owner of this house. This and they will give him some history about the property, and probably will tell him about the rent amount and maybe the payment terms and maybe some other information. Okay, so they will talk about it, and if this man is happy with it, then what's the name? They will draft a tenancy agreement. Okay, so the inception of the lease. Okay, the inception of the lease is when the parties, okay, the tenants and the landlord, they agree on the terms of the lease. So let's say they agree on the rent amount, the payment terms, and maybe other responsibilities, either rules. Okay, when you go to some landlords have some certain rules that they use. Okay, some of them will say you have to make some down payments that when you are leaving, they will use it to they will use it to repair anything that you have destroyed. Okay, so those are some of the conditions. Okay, so the inception of the lease is when the this guy and the landlord, they agree. Okay, the two of them agree on the key terms in the agreement. Okay, that's what we call the inception of the lease. Then let's come to the commencement of the lease. Okay, the commencement of the lease is the start of the lease, or when the date that this person can move to the house. Okay, that's what we call the commencement. Okay, so that is the start date. Is that what? That's the commencement of the lease. Then we have the lease term. The lease term is the period, maybe 2 years. These days in Accra, rent is usually 2 years. Okay, so that's the period of the lease term is the period of the lease. Do you get it? Okay, let's continue. Then let's look at the lease payments. The lease payment is the amount, the rent amount. Okay, that's the rent amount. The amount you pay every year. So usually they will tell you, maybe you have to pay 1,000 cedis, maybe a month, or 1,000 cedis a year, or so that's the lease payment. Okay. Now let's look at another term called guaranteed residual value. Okay, guaranteed residual value. So what is it? Okay, let's say that um you are the owner of a car. Okay, you have a car, and you have a car. So you have a car here, and then somebody is interested to use your car for maybe 3 years. After that, the person will give you back the car. Okay, so you have entered into an agreement, everything. But this person, the owner of this is the owner. This person is the user. The owner knows that the car, you can, if because the car is not for you, you can use it anyhow. You can drive carelessly, drive on rough roads anyhow, bump into potholes anyhow. So for the owner to at least protect himself, or to ensure that this car does not at least lose so much value, okay, this person will tell you that, okay, when you are bringing the car, make sure that the value is a certain amount. Okay, he will tell you that, okay, when you are bringing the car, make sure the value of the car is maybe 60,000. Yeah. So this, and then you also agree that, okay, when I'm bringing the car, I'll make sure that the value of the car is 60,000. Okay. So this is what we call guaranteed residual value. You see, this is the word guarantee. So you have guaranteed that when you are bringing the car, this will be the value of the car. So when you bring the car and maybe you have you overused it, and now the value is, let's say, 30,000. Okay. So this person will not accept it. This person can say, okay, then top up. You bought the car, the value is 30,000, but we agreed that you should bring the value should be 60,000. So add 30,000 cedis to it, so that you give me my car plus 30,000 cedis to make the 60,000. Okay, so that is the guaranteed residual value. Okay, so let's look at an example. Example is company A leased an asset from company B for 5 years. The fair value of the assets at the inception of the lease was 20,000. Company A promised to transfer the assets at the end of the lease period with a residual value of 8,000. Okay, this company said when they are bringing the assets, they will make sure the value is 8,000. Okay, so it means this 8,000 is called the guaranteed residual value. Okay. Then we have unguaranteed residual value. Unguaranteed. Unguaranteed. So let's look at an example. The same example. We have all agreed that okay, I'll I'll make sure that when I'm bringing the car, the value is 60,000. But maybe the landlord, so maybe the owner has his own expectation that okay, he expects the car to be maybe 80,000 when you are bringing it. Okay, but you are saying you can guarantee only 60,000. Okay, but this owner is expect 80,000. So the difference of the 20,000 is what we call unguaranteed, because this one, I mean, if the value, when you bring the value, if the value is below 80,000, nobody is going to pay for it. This person is not going to pay because he has only guaranteed 60,000. Okay, so this 80,000, 20,000 of it is what? Unguaranteed. Okay, it means if the value falls below that amount, uh, the the lessee will not be held liable. Okay, so that is the unguaranteed residual value. Okay, let's look at an example. The fair value of a lease asset at the inception of the lease was 80,000. Okay. Yeah, Mike. Oh, okay, all right, okay. Let me see. Yeah, Mike. I can't see your request. Oh. Can you send it? Yeah, check it. Let's see. Oh, okay, let's continue. All right, let's continue. So we have an example here. The fair value of a leased asset at the inception of the lease was 80,000. The expected residual value at the end of the lease is 12,000, but the guaranteed residual value was 12,000. Okay, so this is the expected residual value. Expected 12,000. Guaranteed 10,000. So the difference of 2,000 is what's unguaranteed. Okay, so that is it.
Max,
Yes.
hello. Please go back and then I just
Okay.
no
Okay. Let me see.
guaranteed and yeah. Okay, so 2000 is unguaranteed. Okay, all
Yeah.
right. Okay.
Yeah. Okay. So now let's look at, so like what, like I said earlier, lease has two parties. There are two parties in a lease. We have the owner and the user. Okay, so the owner is called, this guy is called lessor. This guy is called lessee. Uh, we have lessor and lessee. Okay, so we have two people here. There's a way this person will do his accounts for the transaction. There's a way this person will also do his accounting. Okay. So this person, there's a way the owner will be receiving. He's the one who will be collecting the annual rentals. Okay. The owner will be receiving the rentals because he is the owner of the property. So every year he'll be getting receipts. So there's a way he will account for for this transaction. This guy, he will be making payments every year. He has to make payment the this. So he too, there's a way he will account for this transaction. So basically, this guy will be accounting for main payments. This guy will be recording receipts. You see, all right. So now we are going to start with the lessee accounting. How, and usually in most of the questions you get the lessee accounting. Okay, the one who is going to use the property. Okay, we are going to look at their accounting. Okay. So when it comes to lease accounting, it's not difficult. Okay. There are two main things you just have to look out for. You see, the lessee will be making periodic payments. Okay, you'll be making what periodic payments. Maybe every year he has to pay something to the landlord. So this is called the lease payments. Do you get it? This is called the lease payments. So he'll be making periodic payments. Another thing is that he will have the right, because as I'm paying, what am I paying for? Okay, we don't pay for nothing. So he, as he's paying for the right to access the property. Okay, so this will be treated like a liability. Okay, but he will also have an asset called right of use. Okay, because if I'm paying, why am I paying? What benefits am I getting from the payment? So the benefit you are getting is that you have the right to use the property. Okay, once you stop paying, the the landlord will come and evict you fast. So as long as you are paying, you have the right. So you see, these two go together. Paying and having rights, they go together. So when it comes to the lease accounting, there are two main things. These are the periodic payments and then the right of use. Do you get it? Any question on this? You can see is not difficult. Okay. So now let's look at how to determine the lease payments. Okay, this one. Okay, the lease payment is usually will be stated in the agreement that okay, every year, maybe you have rented a place for 5 years. Every year pay 2,000. So these are the payments you'll be making. Do you get it? These are the payments you'll be making. So at the beginning of the lease, okay, you need to know the total amount you'll be paying. So we are paying 2, 4, 6, 8, 10. We'll pay a total of what? 10,000. Okay, at the end of the day, that's the total amount you'll be paying. So this will be like a liability. Okay, we call it lease liability. Okay, once we enter into a contract, it's like you have a liability to settle all these payments. Okay, even though you are not supposed to pay everything outright, but you pay it periodically. Okay, but another thing you have to remember is that all these payments you are going to make in the future. Do you get it? You are going to make these payments in the future. So 2,000 cedis to 5 years now is not the same as 2,000 cedis today. Is that not so? 2,000 cedis in five
Yes.
years now will not be the same as 2,000 cedis. 2,000 cedis today will be bigger than 2,000 cedis in 5 years to come. Is that not so? So it means that this 2,000 is bigger than this. This one is bigger than this. This one is bigger than. Do you get it? Even though they are the same, but they are not the same because of time value of money. So you have to find the present values of all the payment, you see, you have to find the present value of, or to get the proper liability, you have to find the what, the present values. Okay, and usually they will give you the discount rate. Okay, they will give you the discount rate. Okay, so we call something so what it means is that all these payments you are going to make in the future, there's an interest in it, because the landlord knows that you are going to be paying this amount in the future. So there's a certain amount of interest included in these figures. Do you get it? Yeah. So that is, so that interest amount is what you'll be giving as the discount factor. Okay. We also call it internal rate of return. Okay, we also call it internal rates, internal rates of return. So what is internal rate of return? So let me show you something. Let's say that you have gone for a loan of 50,000. You gone for a loan of 50,000. The bank says every year pay maybe pay maybe 20,000. Pay 20,000 for 5 years. Okay, 20,000. So this 20,000 includes the principal and the interest. Okay, so 1, 2, 3, 4, 5. Okay. We have gone for a loan of 50,000. The bank says every year pay 20,000. Okay. So how do you know the interest in this loan? How do you know the interest portion? Okay. How do you determine the interest? Okay. So that is where we use the internal rates of return. Okay. We use what we call internal rates. So internal rates of return is the interest rate that is included in this amount. Okay. So we can determine the internal rates of return for this payment. So I'll just select all of these, and this is for 29%. It means that the interest on this loan is what, 29%. So what it means is that if I use 29%, okay, to discount all these figures, I will get 50,000 at the end of the day. If I use 29% to discount all these figures, okay, I will get 50,000. So let's do an example. So year one, I want to demonstrate something to you. Okay, so these are the years. So I'll bring my interest rates. So this is the payments. Okay. Then the discounts. Okay, let's say discount factor. Okay, the present value. So this one The discount factor is 1 over 1 plus 29%. Okay. Raise the power. This is, we are doing financial management. Some small financial management. I'm sure you are familiar with this. Okay, so raise the power 1. That's the first year. Okay, we'll do for the rest. This is raise the power 2. Raise the power 3. Raise the power 4. Raise the power 5. Okay, so these are the discount factors. So we can find the present value. The present value is the amount multiplied by the discount factor. Okay, so when I add all these figures, I should get 50,000. I should get this. Okay, I should get the initial amount. So let's add and see whether we'll get. So we are getting 49,659. So this we didn't get the exact amount because of the decimals. No. So if I let me see, this is 28.65. Let me use 28.65. Even that will be lower. Okay, let me see. 28.65. This is 3. This is 4. This is 5. So you see, we are getting 49,999. So the difference is because of the decimals. Okay, so the internal rates of return, okay, is the interest rate that is included in this amount. Okay, and that interest rate, when you use it to discount all these payments, you are going to get the actual amount. Okay, so let's go back to what we are looking at. Okay, so every year we are supposed to pay 2,000 cedis, 2,000 cedis, right? But included in this 2,000 cedis is an interest rate. Okay, so we call it interest rate implicit in the lease. Okay, you will see it in the question. We call it, instead of internal rate of return, we call it interest rate implicit. So implicit means it is included in the lease. Okay. So let's assume that the interest rate in this lease is maybe 10%. Okay. So we have to find the present values. So we use this interest rate to determine the present values. So the present value for this one, okay, will be 3,000 over 1 plus 10% raised the power 1. This one will be 2,000. This is percent. This is 10,000. 10% raise the power 2. This one will be 2,000. 1 plus 10%. 1 plus 10% raise the power 3. This one will be 2,000. This one will be 2,000. 1 plus 10%. 2,000. 1 plus 10%. Okay. So these are the These are the present values. So I can use Excel to help me quickly determine it. So I have 2005. Okay, so this is 1 over, okay, 1 over 1, 1 plus 1 plus 10% raised the power 1. So this is 2. This is 5. So the present value will be this multiplied by this. We get this. Okay, so that's how it's going to look like. Okay, so when you finish, you add everything. Okay, add everything like this. Okay, so yeah, so we add everything like this. Okay, so at the end of the day, this is called your lease liability. This 7,000 is called lease liability. So that's what you record in your balance sheet. Okay, so even though every year you'll be paying a total of 10,000. Okay, because every year you'll be paying 2,000, 2,000, 2,000, 2,000. So at the end of the day, at the end of the 5 years, you would have paid um you would have paid how much? 10,000. Meanwhile, the actual value is 7,581. So it means the difference is the what? Is the interest. You get the idea? So it means that the actual value of the lease is 7,581. Okay, but you at the end of the day you are paying 10,000, which means the difference is the interest that has been added to it. Do you get it? Are you okay? Is it confusing?
Oh
Hello?
no, it's not complete.
Okay, it's clear. Yeah. Yeah. So what it means is that even though every year you are paying 2,000 for 5 years, you get 10,000. But in actual fact, this is the real value of it. So the difference between this and this is the interest on it, because you are going to pay in the future. So the landlord has incorporated the interest in it. So that's how it is. Okay. So that brings us to the definition of a lease liability. Okay, so a lease liability under IAS 16 is the present value. The lease liability is what? Is the present value of future lease payments. Okay, so when you see lease liability, it is the present value of all the future lease payments. Okay, so this amount is our lease liability, but not this. The difference is the interest. Do you get it? Yeah, but and the interest will be recorded in another in a different way. Okay, so we have learned the lease liability. Now let's look at the other ones. I mentioned that when it comes to the lease accounting, there are two things. One is the lease payment, and the other one is the right of use. Okay, the right of use. Okay, so now we are coming to look at the rights of use. So what is the right of use? Okay, so one thing you have to bear in mind is the right of use go with the lease liability. Like I said earlier, it's when you pay that you are given the rights. If you pay for the year, you can enjoy for the year. If you don't pay, you'll be evicted. So the right of use goes with the lease liability. They get it. So it means the right of use is equal to what? The lease liability. So the right of use and the lease liability are the same, okay, because they go together. But uh, under normal circumstance, they are the same. Okay, they are the same. But sometimes it can change due to certain factors, which I'm going to. Maybe as we are in the case of this guy who was looking for um, the guy he is coming from Kumasi and is looking for a place to rent. Where is he? This where is it? I can't. I think it's this. Okay, so this guy is coming to is looking for a place to rent in Accra. Okay, and now he has used an agent. He has to pay these days in Accra to get a place to rent. You need an agent. The agent will ask you to pay some moving fee and a whole lot of things. So viewing fee, viewing fee, and then that one is even, I mean, one aspect. Then sometimes they tell you to pay registration, and then also after everything that they will tell you to pay 10% of the rent. Can you imagine? So the question is, all those expenses you incurred in getting the accommodation, where should they be recorded? Yeah, where should they? So all those expenses, they will be added to the right of use. Okay, the rest costs. All expenses that you incurred um in getting the accommodation or getting the lease, it will be included in the right of use. So it means at the end of the day, the right of use is the lease liability. Because like I said, the right of use is the same as the lease liability. It's a lease liability plus this any direct cost. But if there's no direct cost, if you didn't incur any pain, okay, then the right of use is just the lease liability. Okay. But if you incurred any direct cost and all that, then you have to add the direct cost to the right of use. Okay. Any question on this? Are we good?
Yes.
Oh, wonderful. Now I can see that you are good. The way you understand this is wonderful. It's commendable. It means that the L5 paper, you are going to blow it. You are going to blow it. The paper will be begging you. All right. So this is an important concept that we need to understand, right? We need to understand. So let's see an example. Okay. So this is the right of use, measurement of right of use. So right of use is the lease liability, okay, plus any direct cost. So direct cost includes any initial deposit. Some landlords will tell you to make an initial deposit. You have to add it. Any initial direct cost. Apart from the deposit, if there are any direct costs like the agent fee, viewing fee, and all those things, you add it. Then estimate of dismantling cost. Okay, this one is not for all leases. Okay, this one is for situations where at the end of the lease you have to dismantle the. Let's say that you you went to rent a store for your business, okay, and then um due to the nature of your business, maybe you had to do some um maybe some extension on the store. Maybe you added some extension to the store. But the landlord says when you are moving, remove all those extensions. Do you get it? You remove it. Okay, so the cost of removing those extensions, okay, you include it here. But remember that this cost will be in the future. Okay, let's say we are year zero. You are going to stay in the building for 5 years. After 5 years, you have to remove this extension you have made. Okay, and this cost you will incur it in 5 years time. Removal of this extension is in 5 years time, not now. Okay, so you have to find the present value. Okay, you have to find the present value. So if you estimate that it will cost you 10,000 to dismantle this extension, you have to find the present value as at year zero, and then you come and add it here. Okay, you will come and, but if you are not going to do any dismantling, anything like that, you will not bring anything here. Do you get it? Okay, let's look at an example. Can someone read it for us? Let's do this example and then we are done. List is a lot,
Uh,
so we will continue.
X
Yeah.
X PLC enter into a lease. The following information is relevant. SPLC must pay 5 annual rental or 100,000 in arrears. SPLC must also guarantee the residual value of the asset at the end of the lease term to be 40,000. SPLC incurred initial direct costs of 5,000. The interest rate implicit in the lease is 8% required. Determine the lease liability. Determine the right of use asset. Right
Okay.
of use asset, yeah.
Okay. Good. Yeah. So we are going to apply what you have learned to solve this question. So first, we have to determine the lease liability. Okay. So lease liability. So first of all, we have to ask ourselves what is lease liability. So like we said, lease liability is the present value of all lease payments. Is the present value of what all the lease payments will be making over the period. Okay, so let's go and check how many payments are we going to make. We are going to make 5 payments. Each person must pay 5 annual rentals of 100,000 cedis. So year one, 100,000. Year two, 100,000. So this is year three, 100,000. Uh, year four, 100,000. Year five, 100,000. Hmm. So these are the payments. So when we finish, when we add them, how much are we going to get? 1, 2, 3, 4, 5. We are going to pay 500,000. Is that not so? Okay. So, like I said, we have to find the present value. We have to find the what? The present values for all these payments. value for all these payments. So what will be the present value for this? So this is going to be 100,000 over 1 plus 8%. You see, they said the interest rate is this. So this is raised the power 1. This one will be 100,000 all over 1 plus 8% raised the power 2. This one is going to be 100,000 all over 1 plus 8% raised the power 3. This one will be 100,000 uh, 1 plus raised the power 10. This one will be 100,000 or 1 plus 8% or okay, so now when you finish, we have to determine the values. So how do we determine the values? So 100 okay. So we'll get the present values. This 92,592. This will be 92,593.59. This one will be 85,733.88. 85,733.88. This one will be 79,383.22. 79,383. 73,503.9. 73,503. The last one. 68,058.32. 68,058.32. So when you add everything together, you're getting 399, 399, 371. Okay, so these are the present values. Okay, so we add everything. Okay. Okay, but we have missed something here. Let me show you what we have missed. We have dealt with this. Now let's look at this. F
Yeah.
Yeah, the else PLC must guarantee a residual value of the asset at the end of the lease term to be 40,000. We talked about guaranteed residual value. So that's also a liability to XPLC. It's a because he has guaranteed, so it's a form of liability to XPLC. So it means we have to include it in our cash, in our payment. So year five, we will have another. So year five, there will be two, let's say, cash flows. This one, and then the guaranteed residual value, which is 40,000. So we will do our what was the name? What um we'll do our present value. Yes. I can, yeah, we have to add it here. So 40,000. So this it will be the same discount. Then multiply by this. Okay. So at the end of the day, our total lease liability is this. This one will give us 27,333. 27,333.33. So our at the end of the day, our lease liability is going to be uh, this 426,494. 426,494. Okay. So this is our lease liability. Okay. Now let's look at the. Did you all get it? Are you okay with it?
I watched the this thing, the work you did.
Okay, okay. But you understand it, right? I mean, yeah.
Yes.
Okay, good. Yeah. Then let's determine the right of use. Okay. So we said that the right of use is so usually you have to know the formula or how to go about right of use. Okay, we said is the lease liability plus
No question.